Hello and welcome to Portfolio Matters, week 67 weekly update. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research and consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Well, we've got a packed week, I'm afraid. Lots going on. But before we get into it, next drinks will be on Wednesday, the 11th of May, as one of our regular viewers, who goes by the Discord name Miles44, will be in London that night, having attended the Harbour Energy AGM. So we've moved pub night to the 11th of May, and it will be by Waterloo. So please put the dates in your diary. Okay, news this week. So China cut its reserve requirement ratio for commercial banks by 25 basis points to stimulate the economy. In fact, there was a package of finance measures to stimulate the economy. Remember, China is locked down. We will go into this. So Kushan, where Foxconn have a big manufacturing plant making iPhones, has shut down. So expect supply chain difficulties. Mexico has nationalized its lithium industry, and is going to be very tempting for developing countries to start nationalizing resource industries as commodity prices go through the roof. Next, Netflix shares collapsed, as I'm sure most viewers will be aware. The subscriber growth fell by 100,000 unexpectedly as consumers cut back on discretionary expenditure, and that resulted in Netflix shares falling 40%. Now, as we've covered many times on the weekly, we're expecting consumers' budgets to be squeezed. And so I think that what happened to Netflix is a harbinger of what may well happen to other consumer-facing companies. And finally, the yen had a really bad week, and the Fed this week, Jerome Powell gave an aggressive speech where he talked about the need to raise interest rates hard in order to combat inflation. That means the market is expecting strong rise in US rates, and the dollar is rising. And that is going to put a lot of stress on emerging markets and countries such as Japan, which have got incredibly low interest rates. So this is the share price of Netflix, which has fallen precipitately. This is the yen. Now, next week we'll do a bit more on Japan, but essentially Japan have set the 10-year interest rate at 0. So they're buying bonds. Historically, they have bought bonds in the market to ensure that the 10-year yield doesn't go above 0%. Now it's banging up against that level. And so now Japan faces a choice of either having to continually print money to buy endless amounts of the 10-year note or to let it go. And that means that they would rising interest rates. So Japan faces a kind of historic choice the next few weeks. And this is China cutting its reserve requirement ratio by 25 bips, which is not actually that much. Okay, so moving on to economic data this week. So we had Chinese GDP data for Q1. So ignore the columns at the top in this case. There's a Q1. And it actually beat expectations. Expectations were 4.2. It came in at 4.8 for Q1, compared with 4% in Q4 2021. So that's quite encouraging. But they've now gone into lockdown. So expect that number to have deteriorated sharply. And Chinese retail sales for March missed expectations and showed a sharp contraction, down 3.5%, whereas in February they were growing 6.7%, and that's going to get worse in April. Now, in the US, we had housing start numbers, and they were strong. We'll show you a chart in a second. But the number of housing starts continues to rise, which is rather surprising given the deteriorating affordability metrics and rising mortgage rates, as evidenced by the 30-year mortgage rate blasting through 5% and is currently at 5.2%. So in the EU, we had new car registrations deteriorated sharply from February to March. We don't have consensus expectations for this number, but they're down 20.5% year on year in March. The big number of the week was German producer price inflation, which blasted through expectations, which were very elevated, expecting 26%. It came in at 30.9%, the highest number on the chart, which we will show you in a second. And UK consumer confidence for April was very poor, missing expectations. The expectations were there to be pretty bad at -33. It came in at -38, which is close to an all-time low record reading. Richard, charts.
Thank you, Keith. So UK consumer confidence, as low as it was in 2008-9, obviously really severely damaged by inflation, I think. UK retail sales, you would expect those to fall in line with consumer confidence, and obviously so far that is following. We need the next month's data should be really indicative of whether consumer confidence is being reflected in a significant decline. German PPI chart says it all.
Now, during the week, Richard and I had a board meeting for one of our companies, and the chairman is also the chairman of Horseguard's Dry Gin, which is available on the internet. But he was talking about the impact of rising producer price inflation on his businesses. And so he was talking about 30% rise in costs, which is what we've seen from the German producer price inflation. And that's rising glass costs, rising paper costs, rising printing costs, etc. And that is squeezing margins. And you can't pass on 30% producer price inflation when you've got wages which were growing less than inflation. So I'm really expecting that corporate profit margins are going to be squeezed, and we haven't seen that come through yet. But I just can't see how market expectations of continued earnings growth for the corporate sector can be justified given what's going on.
Completely agree, Keith. And we'll also start to see margin compression to such a point that some businesses won't be able to survive, I suspect, which is what happens in a recession. So US industrial production had a fairly big fall in the 6 months or so ago. It seems to have stabilized that fall and now is at around about 5% year-on-year growth. US capacity utilization still increasing, which is optimistic for the US economy, but it's nowhere near full capacity. And the US mortgage rate is rising very fast. The question we have to, the conundrum is, we've seen a few of these charts where we have a serious spike in the levels of, and the question is this spike going to continue up towards maybe 8% or so?
But it's also the speed with which it's rising, Richard.
Exactly.
This is going to cause highly indebted borrowers a lot of stress, because when they come to refinance, they're going to find that the rate has massively shot up from last year.
Yeah, no, I'm not an expert on this. My understanding of the US mortgage market is that people fix the term of the mortgage, which if that is mostly correct, it means that the pain comes when either they want to move house and have to refinance for that reason, or with new buyers, first-time buyers, which suggests that there's going to be some adjustment in the house market pricing.
We've got a section on the US housing market coming up.
US initial jobless claims, very stable. And continuing jobless claims, just still ticking down gently, sort of slow rate. China GDP growth rate year on year, 5%, or just as we heard, just below 5%. As ever, the caveat is we don't entirely understand the Chinese data.
Yeah, I love the smooth line there. You know, it's a political number, but we report it anyway.
Yes. And Chinese industrial production year on year, which is showing significant growth. Chinese retail sales. Now, this is more believable given the problems they're having in the property market and the lockdowns that they're experiencing. But it's also slightly contradictory with GDP.
Yes.
And US revolving consumer debt, having come off sharply during the pandemic, is now rising sharply and is heading towards a new all-time high by the look of things.
Of course, we don't know whether this is consumers feeling confident again and going out and spending, or actually consumers stressed and putting their bills on the credit card. Now, given what we know about very low US consumer confidence levels, you fear it might be the latter.
Yes. German 10-year inflation expectations. So this is a chart of the index-linked, inflation-linked bonds, and it shows that the 10-year inflation expectation is 3%.
Yeah. Okay, thank you, Richard. On to Inflation Watch. And we only new data we had this week were Japanese numbers for March. And they ticked up quite sharply, actually. So Japanese inflation is now 1.2%.
So the Japanese have a serious problem, don't they, in that if they allow the interest rates to rise, the Japanese central bank is bust. And that's why, effectively, I believe that's why they want to have yield curve control, but they're experiencing very significant price pressure from their imported energy needs because they shut all their nuclear power stations. And so they're between a rock and a hard place in this respect. And of course, the way out is for the currency to fall, which is what it's doing. But that is itself inflation.
Yes, exactly. And this chart shows that US markets are expecting inflation to fall over the coming year, but to still be 5.7% in 12 months' time. So they're essentially expecting the Fed to raise rates, but not enough. Container shipping rates from China are coming down, but given there's a lockdown, you'd rather expect that. I mean, we will show you a chart in a minute showing all the container ships and commodity bulk carriers lined up outside the ports of China. They can't get in. So if you can't use them, you're not going to hire them. And this is the UN Food Index, which had its worst ever month in terms of month-on-month rise in March.
Yeah, and this is frightening, isn't it?
Yeah.
And so apparently the Chinese rice harvest is going to be poor this year. There's an article in the FT this morning written by the Ukrainian Prime Minister, which says that Ukrainian farmers are hoping to plant 70 to 80% of agricultural production.
Wow.
We know that Russian production is bound to be affected by the war. We don't really know whether it's going to be production or the transportation of it, or what sanctions might prevail. So we are undoubtedly heading towards a food crisis.
Yes. Well, we have a special section coming up on agricultural commodities, which we do occasionally. And spoiler alert, it ain't looking good. So this is from the FT. Cheddar price is up 55% in the last couple of years. I mean, inflation is absolutely everywhere. And this is the price of whole milk powder. I couldn't resist a few puns there, Richard.
I hadn't noticed them, Keith.
And this is UK real earnings falling. Yeah. And the companies that we are invested in as angel investors are seeing slowing revenues in consumer-facing businesses of a quite astonishing extent.
Yeah.
And it's likely that the fall in earnings is going to get worse as inflation keeps rising.
So I suspect we are beginning to enter wage price spiral. It's difficult to know, and it's also very difficult to pinpoint when it might start. But I saw that one of the large rail unions is calling out, is suggesting there's going to be the biggest rail strike possibly ever, but certainly it takes you back to the 1970s and the wage price spiral we had there with trade unions calling large strikes. This is for paying jobs. I think it's, I think we're going to see the probably fairly rapid reunionization.
Yeah. A summer of discontent.
Yeah.
And this is Dutch energy prices for consumers, so the CPI component. And everywhere throughout Europe, consumers are going to be squeezed by rising energy prices. Okay, on to Inflation Watch, which will be quite brief. So this was last week, this is this week. Not much change, really. One thing I wanted to talk about was the pendulum of war. So what happens when one side attacks is that it uses its best troops and its best equipment. And if the opposing side can resist that attack, essentially the attacking side uses up its best men, its best officers, and its best equipment. And then the pendulum of war swings back because the advantage goes through to the defending side. And I think that's what we're seeing now.
I was going to say, just a couple of points to add in, Keith. I completely agree with you. I think that the US, I was reading today, are sending a specially developed drone to Ukraine, specially developed for their own particular needs, which clearly is highly ensuring that the forces that use it are highly maneuverable, and I suspect heavily armed with anti-armor weaponry. And the other 2 points I'd make is that classic military doctrine says that an attacking force needs a numerical superiority of 3-1. The Russians don't have that. And also, in some senses, the Russians are fighting a 300-mile front on both sides. So they have, obviously, they're trying to push into the east. They're fighting to the east of their line, and the Ukrainians are coming back up behind them. So they're going to have to fight to the west. And it just strikes me that they put themselves in a really dangerous situation.
We hope so. We hope they'll give up, but this war is likely to grind on for as long as Russia has the will to fight.
The other thing I would say, finally, is that I also read an article which suggested that NATO is desirous of ablating Russian forces as much as possible. And clearly, by neutering Russian conventional forces, it makes NATO's life much easier, but it also, in some senses, raises the ante for Putin to start using biological, well, not biological perhaps, but chemical and nuclear weapons. And I think that's a concern.
That is a concern.
So we thought we would counter our somewhat bearish demeanor presently with a little excerpt on why we should be bullish. So this is taken from a Robert Armstrong article in the Financial Times. And basically, he says the current consensus according to Barclays aggregate of economists' forecasts is that real growth will remain above 2%. Core inflation will continue to slow. Bearing in mind, this is economists' forecasts. Unemployment will stay near 3.5%. Housing demand will tick down a little bit. The S&P 500 earnings per share will grow modestly. Interest rates will rise about 200 basis points in the next year. And with all of that, there's a 1 in 4 chance of a recession. So the bull case is the economy is very strong. 2% interest rates by the end of 22 can be shrugged off, which is probably true. And the economy will slow as rates cause the housing market to cool, but it won't crash. There we are.
Yeah.
I have to say, I'm slightly skeptical, Keith.
We're meant to be trying to be bullish in this particular segment, Richard. I think we're both failing. Is that,
Yes.
To me, this just shows that, the relative worth of economists' forecasts. They're always behind the curve.
Well, there's an awful lot of assumptions in there. If you just flick back to it, it's like core inflation will continue to slow. I wasn't aware that it was slowing. There's a lot of faith in there, isn't there?
Yeah. There's general bullish bias to all these forecasts from investment banks because they want you to buy stuff, basically.
Yes. Yeah.
So we're meant to be bullish there. But
Right.
anyway.
We've done our best. Okay, so we thought we'd do a little bit on the Chinese lockdown. So the Chinese are still going for their zero COVID policy. This is a map showing the incidence of the outbreak, the incidence of COVID per million of population. And you can see it's concentrated in the east of the country and the coastal regions where they have got some quite draconian lockdowns in place. And clearly the coastal regions are affecting the shipping, transportation of goods. And Chinese policy for COVID is a zero COVID policy because the Sinovac vaccine, which they have administered on the whole, doesn't really work very well. So this graph shows the effectiveness of the BioNTech Pfizer vaccine. It's called Commodities here, and versus Coronavac, which is the Chinese Sinovac. And what it shows is the titer on the left-hand scale, the y-axis, is the number of antibodies in the blood, and the protective threshold is around about 30. So anything below 30 doesn't really give you very much protection. So 2 doses of BioNTech just about brings you up to the threshold of protection. But a lot of people don't really have a protection from it. If you go to the 3 doses, skip 1 to Commodities 3 doses, everybody is above the threshold of protection, and some people are extremely, in fact, a lot of people are extremely highly protected. If you look at Sinovac, 2 doses gives no protection, effectively, and 3 doses takes people a little bit higher, but not above the protective threshold. So Sinovac, which the Chinese have administered in the majority to their population, doesn't work. And it can be boosted if you give a 3rd dose of the Pfizer BioNTech vaccine, as we see in the last line, the last description, and that takes it above the protective threshold. So the thesis really is that if you haven't got protection, then Omicron is dangerous. It causes a lot of severe respiratory illness, overwhelms the healthcare system, and is very dangerous to the population as a whole, which is why China has locked down again. And The solution for them has to be the administration of a much more effective vaccine, which means buying it in. And I think they have a psychological problem with admitting that Sinovac doesn't work, and they are completely trapped. So this problem, I think, will not be resolved until they buy in Western vaccines and administer them, succeed in administering them to a large proportion of their population. The mainland is on the left of this chart. It's quite a dark chart. The mainland is on the left, and you can see that ring of yellow dots, which is shipping waiting to move into the major ports of eastern China. And shortages, the supply chain disruption that this is going to cause is probably on a similar scale to the supply chain disruption that was caused by the first wave of coronavirus, first lockdowns in China 2 years ago. So we have a great deal of uncertainty as to what's going to happen to supply chains as a result of this. I believe the other problem is that the R number of Omicron is 12, and had the R number of the original coronavirus been 12, we would probably no longer have a society. I think that modern societies would have simply collapsed. So the danger to China, I believe, is acute. And this will persist as a problem until they vaccinate their population.
Well,
as an aside, if Omicron were to mutate into a variant that could bypass the existing immunity that we have from our vaccination program and from having had Omicron, which many of us have, that shows how dangerous the situation potentially still is. That is not the bullish case, by the way.
Yes. Well, we've all seen the videos on Twitter showing, Shanghai residents fed up with being locked in their tower blocks protesting, and this could get worse. So
this is the ships waiting to load or discharge in Shanghai. So it's an annual view. So we got the 2017 to 21 range running along the bottom in light grey. The average for 2017 to 21 is in black. And then we've got this huge spike now in 2022, which actually is larger than we had at any point during 2017 to 2021. So China's coronavirus vaccine is not effective against Omicron. And it's got this huge R number, which means it's really difficult to make a lockdown work, which is why they've been so draconian about it. And China will have to source large quantities of Western vaccine or create its own effective vaccine. Without that, there will be ongoing supply chain disruptions. I mean, I think also it will accelerate the move away from Chinese manufacturing.
Yes. Deglobalization.
Yeah.
Thank you, Richard. Okay, on to US housing again. And this is an ongoing topic because the US housing market actually is a key driver of the US economy, which in turn is a key driver of the global economy. Okay, so this is latest data which shows existing home sales declining, but building permits are really high, and new home construction is also really high. But housing affordability is really deteriorating. So this is house prices divided by real disposable income. And obviously house prices have shot up, whereas disposable income has declined. So this is not a happy looking chart.
No.
And the housing affordability index, and this is for the latest data is for February. Bear in mind that mortgage rates, 30-year mortgage rates have accelerated markedly in March and April and now hit 5.2%. So this is going to have got significantly worse. So 100 on this chart means that a family earns just enough to qualify for a mortgage. Higher is better. So you're above the threshold. And so I think we're going to be rapidly heading back towards 100. But it's not just a US problem. There has been a global housing bubble, and these numbers are really astonishing. So starting in 2000, Australian house prices are up 384%, Canadian 360, UK 240. The US actually is not too bad. It's only up 166%. Japanese houses have fallen 30%. So in conclusion, I think that the rise in interest rates, which has really accelerated in the last few weeks actually, has put the housing market on borrowed time. Consumers are facing falls in real earnings, mortgage rates are rising rapidly, and house prices are extraordinarily elevated after this long bull run. So housing affordability is plummeting. Also, house builders are building low record numbers of homes in the US. So I really question whether, when these houses are finished, there will be consumers there to buy them at the asking prices they have assumed. So investment implications are house building and construction stocks are likely to continue to underperform.
It all hinges, doesn't it, on whether the central banks are able to control interest rates.
Yeah. Well,
if they are, then we continue to live in this somewhat strange world. If they're not, then asset prices crash.
When mortgage rates have hit 5.2%, then, you know, they're not in control of that. That has risen very, very sharply.
That's so true.
I would also say that that is part of their purpose. They need to get interest rates up to kill demand. And, you know, they'll raise interest rates until they start cooling the economy.
Yes, except that when the value of treasuries falls sufficiently, then all sorts of institutions go bust. So again, a lot of the world is, the financial world is based upon security of US Treasury debt. And if a bank is holding that and it's repoed that debt and it takes a 15% hit, then a lot of the security that's held by financial institutions is no longer worth what they thought it was worth. And so the ramifications are enormous. It's not just the housing market, it's the stability of the financial system that is under threat if interest rates are allowed to go up too much, I think. So, yeah. I don't think they can let them go up.
Well, I don't think they're in control of the long end, frankly. And I think the fact that 30-year is now hit 5.2% is an illustration of that.
Yeah, I think you're right, Keith.
Okay, and on to chickens. So, I thought this is really interesting. So
that's enormous. That's extraordinary.
So, back in 1957, the average chicken looked like that, and it weighed 905 grams. So during the war, there was rationing, and beef in particular was heavily rationed. And so people got used to eating chicken. Then in the post-war period, the supermarkets were worried that people would go back to eating beef and they would eat less chicken. So essentially they had this competition, this explicit competition to try and breed fatter chickens that grew faster to bring down costs, and they were astonishingly successful. So in the past 50 years, the average supermarket chicken has increased in size by 364%. And so these are exactly the same numbers from The Economist. And as a result, chicken is very cheap and is eaten in huge quantities by American consumers. So they consume on average £65 per capita, or £26 billion in total. And some metrics, I found this absolutely amazing. So in 1925, it took 112 days to grow a 2.5 pound chicken. Now it takes 47 days to grow a 6.12 pound chicken, and it consumes much less feed, actually. So it's much more efficient. So it grows quickly and efficiently, and they're pumped full of antibiotics, so they hardly die. And so when you look at the, sorry,
thereby enhancing antibiotic resistance.
Precisely. So they're now slaughtered really before they're fully grown. We're eating kind of enormous baby chickens.
Doesn't make you feel good about eating chicken, does it, Keith? It really doesn't.
No, it doesn't. This is what they're like these days. They're fed, instead of roaming around the farmyard eating bugs and worms and whatever's going, they're fed on a diet of corn and soybeans, plumped up and slaughtered as soon as they reach size. And we will go through agricultural prices in a minute, but just like everything else, feed prices have gone up, so the price of chickens has gone up this year. So I thought this was a really interesting example of human ingenuity and the power of economics in this forced evolution of the chicken. So in 1948, a whole chicken cost around $3 then, which is the equivalent of $30 today, whereas you can now buy a whole chicken in Tesco's for astonishingly low prices, actually probably around $3. But chickens have been bred to be cheap. They haven't been bred to be healthy, tasty, and nutritious. Now, proper chickens are available, but they're going to be very expensive. And the reality is consumers just aren't willing to pay the price.
Yeah, that's really interesting, Keith, but it's also rather disheartening. I find it rather disheartening. I read a letter in the Financial Times today, and the Financial Times has done had three articles on what some people refer to as the demographic time bomb, which is the fact that the number of children being born is too low to support us old gits in our dotage. And I consider it to be a benefit to the environment and the world that the reproductive rate should drop below 1, because clearly we are consuming vastly too many resources and the planet can't sustain us. So actually having the birth rate below 1 across the world is a good thing in my view.
Yeah.
The articles in the FT do not address that at all. They simply do not address it, which I think is a gross omission. But there was a letter in the FT by someone today that said, took the words out of my mouth basically and said, surely we need to be looking at this bigger picture. And this, chickens, is part of that big picture. The distortions that we are creating in order to feed far too many people on the planet.
I agree. We're meant to be bullish on this, occasionally on this.
So I'm bullish on agricultural commodities, Pete. So moving on to agricultural commodities. And as you will know from what we've been covering over the last few weeks, agricultural commodities generally are rising, prices are rising sharply. So a couple of charts, soybeans have doubled in the last year or so. Wheat has tripled since 2019 really. Cheese, which is a reflection of the input costs, mostly milk, obviously, has, as Keith was saying earlier, cheddar has gone up by about 70%, looking at this graph, since this time last year. Palm oil tripled in the last couple of years. Cocoa actually is relatively modest rise, just on a gentle rising trend. Orange juice is getting on for doubling, but very sharp spike in the last couple of months. Coffee has doubled in the last year or so. Oats have doubled in the last year or so. Rice has gone up 60% since 2019 and is on a sharply increasing trend. And rapeseed oil is nearly tripled. Sugar's doubled. Tea, which personally I don't like, hasn't changed.
Well, I like tea, so this is good news.
And corn has gone up 150% or so. And all of those charts are rising. There's no sign of any of them having reached the top. And so the food component of CPI inflation is very unlikely to have peaked. And the food component is the green bit, down at the bottom, with energy and core CPI making up the bulk of the remainder. So food inflation is really very small. And if it continues to come through strongly, even if other elements of inflation start to cool off, such as energy, for example, food inflation will take its place. What this is really saying is there's a lot more inflationary pressure in the system that has yet to come out that we haven't seen. Rents actually is another one that we've discussed previously. So, unfortunately, food inflation is going to get worse over the coming months, almost certainly. Bad for consumers, very poor for poor nations. And I think the outlook for the next 12 to 24 months in terms of food prices is actually quite bleak, and will probably lead to various famines in poorer parts of the world.
So moving on to other charts, Richard.
Thank you, Keith. So the 10-year versus a 2-year yield curve inversion has been a good predictor, as we have discussed before, an impending recession, but with that lag, several months lag. And the average lead time is around about 19 months. We have had our first yield curve inversion. I may have got this wrong, Keith, but I think it is now uninverted, hasn't it?
It has uninverted. The next chart will show that, Richard.
Yeah, so that would mean that all other things being equal, which we know they're not, the start of the next recession would be around about Christmas 2023.
Yes, and that's what the market is expecting.
So it did invert. You can see it just ticked down below zero at the beginning of April, and it has now uninverted.
Yeah, I mean, I'm astonished by, given all the headwinds the world economy is facing, that the recession indicators aren't stronger. And I go back to your point, Richard, about how reliable are long-term bonds these days, given all the manipulation that central banks have been doing. Is this a reliable indicator these days?
It's very difficult to tell, isn't it? I also think this is one indicator. I saw a chart a few weeks ago where someone had calculated something like 60 inversions of different bonds at different dates, so forth. And they reckoned that for a reliable indicator, you needed to have about 75 of them inverted, and something like only 50% of them had inverted. I mean, the whole thing gets incredibly complicated.
Yeah.
And this obviously is just one of the charts, but it has in the past had this ability to predict the next recession. So as rates in the US rise, typically the PMIs fall, and it's a reasonable correlation. I think there's a lag here of 11 months on this chart. But what this is telling us is that we would expect the PMI to drop below zero fairly quickly because we've had such a rapid rise in interest rates.
Yes.
Real sales, i.e. deflated for inflation in the US, are around about 1% higher now than pre-COVID, which doesn't suggest an economy that is shooting ahead, or just 1% inflation adjusted retail sales. And the consumer sentiment index, as we have discussed, is falling quite fast, but they're still out there buying. And maybe that's partly due partly explained by the rising credit card debt that we saw earlier.
Good point.
And if that is the case, then you would expect that once they max out on their credit cards, consumers will have to draw in their horns. And Chinese imports fell in March. I'm not sure how much, if any, this is due to the problems that China's been having with COVID. Probably it's a bit early for that, isn't it, Keith?
Not sure, actually, Richard. I would have thought they were already experiencing some difficulties in March. But we also know that the Chinese housing market has been suffering difficulties. So this is an interesting graphic from the Visual Capitalist, which shows each country's debt to GDP levels. And so right in the middle, highest in the world, is Japan. And then Greece has debt to GDP of 207%. Now, during the week, we did a special podcast with Stuart Owen on Greek debt sustainability, and I'd urge you to check that out. And sadly, the reason that Greece has a debt of 207% is not because it's been adding loads of debt in the last 10 years. It's just its GDP has collapsed by 40% since the great financial crisis. Then we have Italy at 159%, well above the US at 133%, and Britain at 109%. So if Italy starts to get into difficulties, then it's too big to fail, basically. It can't be saved by the ECB. And we've got a chart later showing you the average the average interest rate on Italian bonds, and it's rising.
So this is a chart showing what happens to US government debt servicing costs as interest rates rise. So current interest rate levels, they're experiencing an average rate of 1.6%. If the average rate experienced were to rise to 3%, then the debt service would rise from around about 400 billion per year to around about 700 billion per year. And at 5%, which is by no means out of the question, the debt servicing would be around about 1.2 trillion. In other words, about 3 times what it currently is. And that would be around about, I'm guessing, around about 5% of US GDP just on debt servicing, interest payment.
Remember that the US actually has quite a short maturity profile. So it does actually have to refinance a lot of its debt each year. Yes. Unlike, let's say, the UK, which has pushed a lot of it out to, 20 or 30 years.
Yeah. They haven't done as good a job as Austria. With their 100-year debt.
Absolutely.
Okay, global investment in energy transition by country in 2021. And China was by far and away the largest investor in renewable energy in 2021. And I think it was also by far and away the largest investor in coal-fired power stations in 2021. So you have to sort of take this with a bit of a pinch of salt in terms of their overall contribution to
well, I think that's the point, Richard, is that, they've got massive growing energy demand. So they're actually investing a lot in the energy transition, but they're still investing a lot in coal, more of that later.
And their CO2 emissions are still rising because their energy consumption is going up and they're producing a lot of it through burning fossil fuels.
This is a really interesting piece from the FT talking about the average experience of UK retail investors on the platform Interactive Investor. And on average, their clients lost 3.6% in Q1. And investors with assets of over $1 million did even worse. They were down 4.2% in Q1. So on the Discord channel, we had an exchange about this. And I hope that regular viewers of Portfolio Matters will have done much better. Some of our audience have done plus 30% in Q1. And I realize there's a strong selection bias here, but we didn't have any of our contributors who had lost money. So, stick with Portfolio Matters. We've given you good advice actually recently.
So this chart shows that the recovery in retail has stalled below COVID levels. So it's down about 15% or so compared with pre-COVID levels, which is part of the picture of the declining consumer confidence that we're experiencing.
Yeah, and declining disposable income, frankly.
And the dollar basket is now up above 100, and that traditionally causes serious problems for emerging markets in terms of the serviceability of their dollar-denominated debts. And whilst the index hasn't reached the giddy heights of 160, which is what it was in the 1980s, it is nevertheless pushing up towards levels that can potentially create problems for emerging markets and their debt servicing.
Okay, so this is a messy chart, but essentially what it shows is that central banks of the world continue briefly to be doing QE. So if you look on the left-hand chart, the green bars are changes in reserves for the Fed, the ECB, and the Bank of Japan combined. You'll see currently the ECB and the Bank of Japan are pumping money into the system, and the Fed has not yet started QT. Now, if everything goes according to plan, then the ECB will cease doing asset purchases in the coming months, and the Fed will start doing QT. And then you'll go from a world in which we've had central banks pumping money into the system to one in which they are net taking assets out of the system. So that will tend to raise interest rates further. And that will happen in the second half of this year. So be aware. That could be bad for equity markets. So on to the equity checklist, Richard.
Thank you, Keith. So the FTSE all share, the stocks Europe, the S&P 500, all pretty much unchanged on the week. And the NASDAQ was down nearly 1.5% on the week. The Hang Seng had a bit of a tumble. I think this is probably due to COVID and the problems with lockdowns in Hong Kong. And the Japanese index is up a little bit, Bitcoin up a little bit, the pound down quite a lot, and the pound has had a poor year to date, down 4.3%. The dollar index almost the reciprocal of the position of the pound. So stock markets around the world have had a poor start to the year, apart from the FTSE.
It's a high commodity weighting.
And this chart shows Apple, the Apple share price compared to its earnings per share and its free cash flow since 2012. So the share price has gone up tenfold, its earnings per shares have gone up fourfold, and its free cash flow has gone up 2.5 times. And you do have to wonder at what point, if you take the Soros reflexivity curve, which I think Keith is going to do something about in a short while, you have to wonder at what point the graph of Apple might come back down to the EPS line.
Absolutely. It just shows that the US stock market, which has massively outperformed other global stock markets, I mean, the key driver has been PE ratio expansion. It's not been driven by earnings. Yeah. So you think that's got to come down at some stage.
And the big winner in Q1, as I think we all know, was energy, up 2.5 times in earnings per shares. And clearly the energy sector was the one to be invested in.
I think what's really interesting about this as well, Richard, have you seen how badly financials have done?
Yes.
You would expect with rising interest rates that commercial banks, their profit margins would expand. But actually, it's been rather the opposite. And you do wonder whether rising interest rates are going to cause a lot of financial stress and bad loans rising, et cetera, whether that is a harbinger.
It makes you feel that people aren't particularly confident about the lending, the finance sector generally, doesn't it? And the power of the banks to capitalize on the increasing interest rate differentials that they may earn sort of overtly, definitely. And it's a big drop as well. It's like 25%, isn't it?
Regular viewers will know that one of the games I play is I try and time the market. So my next move is absolutely going to be out of equities and into cash and then into bonds. Now, one of the arguments for not timing the market is that it's very difficult to predict. And if you miss the best days, if you're out of the market when the market leaps, that has a big effect on your returns. So this chart on the left shows the cumulative returns for the S&P 500 from 1928 to 2022. And if over that period you'd missed the 10 best days of the stock market, then you'd have got a third of the return of not being fully invested the whole time.
That's an enormous effect, isn't it, Keith?
It is, yeah. So, you know, if you're going to try and time the market, you better be good at it.
Yes.
Okay, now this is a complicated table. If you're interested, please pause the video and have a look. But the key takeaway is a very simple one. What it shows is that companies that have been doing share buybacks have outperformed in every period companies that have been doing net issuance. And so that has actually quite big implications for which stocks you might choose to buy in aggregate, because companies that are issuing shares are early life companies which need to raise financing. The companies doing the buybacks are big established companies throwing off cash. And so what this tends to show is that established companies doing share buybacks tend to outperform. But pause the video and take a look.
So this is a chart that shows that investor sentiment is very negative, and actually it's normally only this negative at the bottom of bear markets, but we are not at the bottom of a bear market. So the question is, do we move on to a bear market and sentiment goes much, much worse? Or are we as at the lowest we are ever going to see in this particular stock market cycle? And our stock market is going to go up from here? Or the difficulty in trying to predict this is, in my view, very much is dependent upon what central banks do. Yeah.
Now, the thing is, whenever the sentiment gets overextended like this, it's very negative. You think that at some stage it's going to bounce back, even if things start, events go badly, that investors can't sustain this level of bearishness. So,
yes, but I mean, if the corollary of that is the Apple chart, for example, which
I agree.
One out of a universe of stocks. Investors were very bearish, much more bearish than they are now at the start of 2009. 2009 at the start of the very strong bull market that we've had. So I'm not sure. Personally, I find this sort of information very difficult to interpret.
Yeah, well, what it's saying is that extreme bearishness does not necessarily mean that the stock market, will fall. It could be, in fact, mean precisely the opposite.
Yeah. Margin debt has started to come off a bit. So one of the vulnerabilities, I think, in the markets is the level of margin debt. Margin debt holders are trading on the edge, And it doesn't take a very big movement in the price of what they've purchased for them to suffer much more significant losses. So they're much more likely to leave the market early on quickly and therefore increasing volatility. And as they go, of course, there's consistent selling pressure until margin debt drops. So I think the falling level of margin debt is a healthy sign, although it is still very high.
Okay, so what this chart shows is the balance of companies in the S&P 500, which are having either net earnings upgrades, those are green, or net earnings downgrades, and those are in red. Orange is neutral. And what it shows is that later in the year, more companies are seeing earnings downgrades. So be aware.
And this is consistent with our concept of margin compression, isn't it, Keith?
Absolutely.
So this is a chart that shows the ARK Innovation ETF from 2016 to present, overlaid on the dot-com bubble. So this suggests that the ARK Innovation ETF may have a little bit further to drop, i.e. down to around about, let's say, 30-ish from where it currently is, i.e. half. And then it may be a good buy.
Temporarily, as just sort of technical analysis, Richard. I mean, frankly, what's the fair value of this thing? 2?
Difficult to tell, Keith.
Yeah. Well, I can tell you it's like 2. Okay, moving on to commodities. So, well, I think a lot of our regular viewers have had a great quarter and are heavily long commodities. Well, the concern is this is a crowded trade now. So the survey of fund managers shows that they are the most overweight commodities they have ever been. And frankly, crowded trades are dangerous because they can unwind very quickly. So something to be aware of. Okay, moving on to energy. So it's generally a poor week for oil, down 4%, although obviously last week was an extraordinary week when it was shooting up. So come off a bit. Dutch natural gas futures up 10% on the week, up 50% on the year. That's 3.5 months. Coal continues its relentless rise, up 5.4% on the week, up 95% on the year. That's 3.5 months. Uranium came off a bit, was still up 40% on the week. Moving on to relevant data for the oil market. Well, past couple of weeks, we've had inventory builds, and last week we were concerned that presaged demand destruction was potentially bearish for the oil price. Well, this week that massively reversed. So there was a total draw in the US of almost 13 million barrels. So demand massively outstripping supply. And if you look at private oil inventories, so allowing for the release of oil from the Strategic Petroleum Reserve, well, it still drew down by 8 million barrels. So that is very bullish for oil. Now, US crude production ticked up by 100,000 barrels a day on the week, and that means year to date, their production's gone up by 100,000 barrels, i.e. not very much. There's not much of a supply response to these very elevated oil prices, and the Baker Hughes rig count ticked up by 2. So this is oil, just very volatile, but definitely above 100. I attempted to cover this chart last week, but messed it up. So we'll do it this week. So what this chart shows is what the EIA is expecting in terms of production growth. So they're actually expecting growth from OPEC, the US, and Brazil, mainly, of a total of 3.1 million barrels a day by December, but then a fall in Russian production of minus 1.3 million. So net, a growth of 2.2 million barrels a day in supply, in world supply. Now, I am deeply skeptical. I just don't think, there's no indications so far that the US's production growth is going to be anywhere near this big. Bear in mind, it's currently, it's not 0.3, it's 0.1. And the direction of travel does not look consistent with a growth of 1.4 million. And we also question whether OPEC have anywhere near that spare capacity. And world oil production is still below its 2018 peak. So US oil production remains well below its pre-COVID highs. It has ticked up. It's now up on the year, but well below where it was a couple of years ago. And this is really interesting. So we've previously talked about how Russian oil exports do not appear to have fallen as much as people were suggesting. And last week, we talked about how actually they seem to have gone up slightly. So the Russians have massively cut the price of their crude relative to Brent, and they're finding people to take it. Well, this chart shows that, yeah, they may be exporting their oil, but the sanctions, the lack of Western expertise is now impacting their ability to actually produce the oil. So production has fallen, according to Reuters, to about 10.3 million barrels in the first 10 days of April. Now, Bloomberg have got updated numbers, and they're saying it's fallen to 10 million barrels. So Russia may have the export channels, but it can't produce the oil. So this is very bullish for the oil price. So the volatility of oil prices has massively increased. And as you will be aware, that means that margin requirements for oil traders, commodity traders, have shot up, which means that they've cut down on the volume of their futures they're holding, because frankly, they just can't afford to hold huge volumes of futures given the margin requirement. That means liquidity has dropped in the oil market. So that is the chart bottom right. And as a result, liquidity in the oil commodity markets has fallen. So if you want to hedge, you're going to have more difficulty doing so. And that means less liquid markets, potentially more volatile. So tail events become more likely. You're going to get more volatile oil prices. Moving on, this is the crack spread. So essentially it shows the spread between oil prices and distillate products. And we know that the loss of Russian cracking facilities has meant that there is a lack of capacity in the West to convert crude oil into diesel, for example. So the crack spread has shot up, and that is great for refiners and the majors who retain some refining capacity. So this is Dutch natural gas futures. They ticked up on the week. Reminder, they're 4 times higher than they were a year ago. And this is the gas held in storage at the Raiden facility in Germany, owned by Gazprom, and they have run it down to 0. Now, this is a really interesting chart, and it shows the destination of LNG exports from the US, and you'll see this mid blue line is exports to Europe, and essentially they've come at the expense of everyone else. So you look at exports to Asia, dark blue, they've fallen. Exports to Latin America, they've fallen. Essentially, Europe is outbidding the rest of the world for LNG. Because there's a lack of facilities in the US to liquefy natural gas for export, there's a huge differential between US natural gas prices and European natural gas prices. And that means if you can export it, there are absolutely enormous profits. So it costs you 20 million bucks to buy a cargo of LNG. You can sell it in Europe for 272.
That is a profitable business, Keith.
Yeah, I bought some Flex LNG this week. We'll talk about that later. And Russia talks about its pivot to China. Well, that's going to cost it money because the dark blue line is the price of gas in Europe. The green line is the price of gas in China. So, you know, if Russia has to sell gas to China instead of Europe, it's going to be costing it a lot in lost revenue. This is coal, frightening chart. It's relentlessly rising up threefold on last year. Pause the video and have a look at this. But what it means is if the EU bans Russian coal, then they're going to have to compete for coal in the open market. And that means grabbing shares from China and India. And the question is, you know, what's that going to do to the coal price? It will go even higher. But the flip side of that is that the rising coal price has incentivized China to increase its coal production capacity. So this year it's intending to add production of 300 million tons to its existing capacity of 4 billion. Hugely bad for the planet. And this is uranium price ticked down this week, but still it's had a very good run. Okay, Richard, industrial commodities.
Thank you, Keith. So fairly quiet week for quite a few of the industrial commodities, actually. They've got substantial gains in the year to date. But things seem to have calmed down. Magnesium was a decent sized move, had fallen 2% and 25% year to date. Neodymium has actually basically remained flat on the year, and nickel is still rising. Obviously, it had that huge spike, but it is now trending gently upwards. Tin down a little bit on the year. Ferrovanadium had a big move for reasons I don't know. And zinc was up very slightly. The big moves in these commodities are often quite hard to understand what's going on. I think
now the move in ferrovanadium, it's still up 55% on the year and is now unwinding, but mystifying.
It is mystifying. I'm not, you know, are there ferrovanadium speculators? I don't know. So there's the aluminium price. And cobalt, which has stabilized for the last few weeks. Copper is actually just on a gentle uptrend. Chromium. Iron ore has basically leveled out in the last 6 weeks or so. Lithium. It was interesting that Mexico has nationalized all of its lithium mines, and I don't know what impact that will have on the price, but I know what impact it would have on the desirability of South American miners, as we referred to earlier. Magnesium. Neodymium looks like it basically got well ahead of itself, and it's still coming off. Nickel has got this steady upwards trend from the start of the year at 2000, and now it's nearly doubled, and take out that spike, which suggests we've seen data suggest that there is a shortage, and it suggests that that is impacting the price. Tin, after its very strong run, has come off and is relatively steady at this price. Ferrovanadium, as I said, don't really understand the pricing of that. Zinc is continuing its strong upward trend, really. Moving on to precious metals. Gold's down 1% on the week. Silver took a bit of a hit this week, down 4.4%, which is a big drop. Platinum and rhodium both down 2.3%, and the only one rising, palladium, up 3.5%. Given the inflationary environment, the behavior of gold and silver is hard to understand. It's difficult to understand what's going on. We've got very poor inflation news, and the price of gold is down 1% on the week. So there we have gold, silver, platinum, rhodium, and palladium.
Yeah, it's striking that the price of palladium is essentially unchanged since the Russian invasion of Ukraine, when you know that Russia produces 45% of world palladium.
Yeah, hang on.
Okay, on to rates. And there were moves across the curve this week. So the UK yield curve shifted up. So when you look at the change from the start of the year, it's really extraordinary. From the start of the year, the UK 30 year was yielding 0.04%. Is now yielding 2.1%. So in 3.5 months, it's gone from 0.04 to 2.1. In percentage terms, that's an absolutely enormous change. And you would think that that is going to be causing quite a lot of financial stress to heavily indebted entities. We're waiting to see the consequences of that big rise in rates. Now, moving on to the Eurozone periphery, the rates rose throughout Greece, Italy, and Spain, but not to terribly elevated levels. So they're kind of compatible still with the UK. So no sign yet of a return of the Eurozone crisis. But this is a chart of Italian bond yields. Italy, as you saw earlier, is one of the most indebted countries in the world. And if we have any rise in the implicit interest rate on Italian government debt, that will have a big impact on its fiscal sustainability. And you could see a return of the Eurozone crisis quite quickly once the ECB stops asset purchases.
Well, I think we just need to say if there, Keith, because I'm not sure we'll be able to stop asset purchases.
And so this is the annual return of Barclays Aggregate Corporate Bond Index in every year since 1977. So the best part of 50 years. And you'll see that this year has had the worst drawdown ever. And this provides further color. So it provides the breakdown by bond class. If you're interested, please pause and have a look. Now, we talk on this podcast about yields all the time. What we don't talk about is the price of bonds, which is the reciprocal of that. So if we look at a UK 10-year bond, so this is the UK 2031 gilt. So it's got a duration of 10 years. And you'll see if this chart is from London Stock Exchange, it shows the price. And it shows that from its December 2021 highs, the price is down around 10.7%. Now, if we look at longer duration bonds, so this is the price of the 50-year. So it's got a duration of 50 years. It's the UK 2071 gilt. see its price has fallen by 38% from its December highs. So those are big numbers. So it goes to show the risks of holding long-dated security, long-dated bonds when interest rates rise. So investors who held this have suffered a 38% drawdown. And frankly, I suspect it's going to get a lot worse. Now, the flip side of that is when the cycle turns and the interest rate cycle starts to come down, then there's the potential for the price of this to go back up towards its highs. And having fallen 38%, in order to get back to previous highs, you're talking about a 60% plus rise. And remember, gilts for UK investors are capital gains tax free. So frankly, that is the game I shall be playing. This is the 10-year gilt. That looks a relentless rise, frankly. And this is the US 10-year, similar pattern. And finally, on to the S&P futures seasonal chart, and bit choppy, which is what we're expecting, but then May is a good month. End of April, early May, good for the market. Richard, what have you been up to this week?
Thank you, Keith. So there was a very quiet week for me. Tiny, effectively no change on the week. FTSE all share was down 0.2%, so my relative performance increased a little bit. Sadly, I'm not approaching the 30% plus of some of our Discord members, and never mind, hope springs eternal. I did no purchases and no sales, but I just thought I'd cover a couple of interesting charts. So this is the Ethereum log chart that we haven't talked about for quite some time. And I thought let's cover it briefly. We put it back up here, and you can see that basically, since the price of Ethereum cut through that trend line back in last autumn, it has basically marked time. Although this is a log chart, so it covers up quite a lot of volatility. The price has marked time. I am holding my Ethereum. I'm a long-term holder. For the time being. And the next one I want to look at was Cameco, which is a uranium favorite. And what struck me about it, and which I hold, what struck me about it is how volatile it has become. Yesterday, there was a 10% fall in the price of Cameco for no particular reason that I'm aware of. I mean, the thesis, if you believe the uranium thesis, which I do, the thesis is there, it's strong, hasn't changed. And yet the volatility is enormous. And you can see really the volatility picked up back in late 2021. And it's one of these shares where you have to understand why you're in it. You are in it for the long term and not be put off by that volatility. But
yeah, well, it goes to show what happens when you're in a crowded trade, Richard. And the whole commodities space, I think, is now quite crowded. And so you've got lots of nervy new holders.
That's probably very true, Keith. Yeah. So the idea is to be in it for the long term, and therefore you have to have a position that's such that it enables you to ride out the quite big swings. So we looked at the graph of US crude, but I have seen this referred to elsewhere. This is forming a big triangle, and the question, if you're a chartist, you look at this, say, well, if it breaks out to the upside, then we're off to above the high of 130, and it is forming this big triangle, as is, interestingly, the price of wheat. That was also in a triangle, and we don't really know what the future is for commodity prices. I think we suspect that agricultural commodity prices are going to continue to go up. We've talked about the crowded trade in commodities, the fact that you need to be much more careful now than you used to be. So I just thought these two charts were interesting to just have a little look at. And that's me, Keith. How about you? What was your week like?
Thank you, Richard. I had a poor week. down 0.8% as oil came off and lots of oil companies had a poor week. Although I noticed actually the majors were strong, it's just everyone else was coming off. And I think that majors are making just absolutely astronomical amounts of money from refining currently.
Yeah.
So that took me to plus 20.8% on the year. So having a good year. Now, I did do, frankly, some tinkering this week. So I sold a bit of diversified energy. On our Discord channel, I have posted a report that Mike Lee sent me about diversified energy. And essentially, it's a bit of a hatchet job by the Ohio River Authority. And they're talking about how methane emissions are much higher than DEC admit, etc., etc. And now they do make some good points, but I think diversified energy are addressing those. They are retiring wells at an accelerated rate compared to previously, and they've just bought this company that has methane emissions monitoring equipment. So I think that DEC will be doing very well as its hedges roll off and it re-hedges at higher prices. But I did sell some from my main brokerage account where I have to pay the 15% withholding tax. If you hold it in the SIP, you don't have to pay that. And I have retained everything in my SIP. I also trimmed some of my other positions. Essentially, I had put in some limit orders and they got hit. That's great. So just slowly reducing my exposure, basically. Now, I was unable to resist buying some Flex LNG, which has a very good dividend yield of 7% plus and runs a fleet of LNG tankers. And frankly, I think as the old contracts roll off or whatever, they were exposed to just a structurally strong market. So I have started buying some. The shares came off, I bought some, and I will be looking to add to that position. I also bought some Southern Energy, which is drilling various wells, which if they come through will be transformative. And I have one coal stock, Contango Holdings, which has got an absolutely enormous resource in Zimbabwe. And as it develops that, I think it should be a proper multi-bagger. But so far, the shares haven't moved. I should also say thank you to Simon W. for making me aware of Flex LNG. Now, in other matters, Rogue Trader, who watches this, has done a video on Total Energies, which is very good, but also he talks about the future strategies of Shell, BP, and Total. I found that really interesting. If you own Shell and BP, I think it's well worth watching his video. So I'll try and put a link in the description of this. But anyway, on my main brokerage account, although Total is listed in London, they won't allow me to buy it, which means that, I've got difficulties in actually buying some. Next cycle, I'll try and work out a way of buying some Total, because he makes a good case that they have a better strategy than BP. Okay, this is Serica Energy. Serica Energy came out with results which were good, but they also reported guidance for the coming year, which is about 10% below expectations. So the shares have come off, but it still had a very good run. This is Hunting, which announced results, and I think I and the market was expecting them to beat expectations, and they failed to do so. So it's had a good run. It's come off a bit. This is Gulf's Keystone, which is a core position of mine. And frankly, it's just got a bit too big. It's up 220%, so I trimmed a bit. At 250, I had a limit order in, got hit. Marvelous. This is Diversified Energy, which, the share price has been, frankly, a bit disappointing. But
is that because of their hedges, Keith?
yeah,
They
well,
have
yes, absolutely. But I mean, it yields like 12%. So I'm very happy to hold that in my SIP, where I don't have to pay the withholding tax. This is Southern, bought a bit more. Doing George Soros's, dictum of adding to stocks in a strong upward trend.
Yeah.
This is Flex LNG, which I bought here. So, and finally, Contango Holdings, which, given the strong trend in the coal price, hugely disappointing, and it's got an absolutely enormous resource. At some stage, I'll do a share talk on it. And that is it. Long one today, lots to get through and a lot going on in the market. But thank you to watching to the end. Please, can you press like and subscribe to the channel? And if you feel kind-hearted, consider making a donation to Portfolio Matters so we can cover some subscription costs and stuff. But in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.